In the year 2000, Enron was the seventh largest company in America, revenue of $101 billion. Named the most innovative company in the country by Fortune magazine 6 years in a row. Its stock traded at $90 a share. Wall Street called it the future of energy. Within a year, Enron filed for the largest bankruptcy in American history. 20,000 employees lost their jobs. Billions in retirement savings vanished overnight. And the profits that made Enron the darling of every analyst on Wall Street turned out to be fiction, constructed through accounting tricks so elaborate that the people approving them didn't fully understand what they were approving. This is not just a story about corporate greed. It's a story about what happens when no one in the system, auditors, analysts, regulators, or the board, has any incentive to ask whether the numbers are real. Enron started as a pipeline company. Kenneth merged two regional gas firms in 1985 and built a conventional energy business based in Houston. The transformation began when Jeff Skilling arrived from McKinsey in 1990 with an idea that would reshape the company and eventually destroy it. Skilling proposed that Enron stop thinking like an energy company and start thinking like a trading firm. Instead of just transporting gas, Enron would create markets, buying, selling, and trading energy contracts the way Wall Street traded securities. To make this work, he pushed for a controversial accounting method called mark-to-market. Mark-to-market allowed Enron to book the entire projected profit of a long-term contract the moment it was signed. A 20-year gas deal worth hundreds of millions in future revenue could appear on the books as profit today, before a single dollar had been collected. The SEC approved it in 1992. It was the decision that made everything else possible. Mark-to-market gave Enron the ability to manufacture earnings on paper. But as the company expanded into broadband, water, and international projects, many of these ventures were losing money. Enron needed a way to make the losses disappear. That job fell to Andrew Fastow, the chief financial officer. Fastow created a network of special-purpose entities, off-balance sheet partnerships with names like LJM, Chuco, and Raptor. These structures existed for one purpose: to absorb Enron's debt and disguise its losses so they never appeared on the company's financial statements. Here's how it worked. Enron would transfer underperforming assets to a Fastow-controlled entity. That entity would pay Enron using financing that was ultimately backed by Enron's own stock. The losses were gone from Enron's books. The debt was hidden. And Fastow personally collected tens of millions of dollars in management fees from the entities he created. It was a closed loop. Enron was essentially doing business with itself, using its own stock to guarantee deals that existed only to hide the truth about its financial condition. As long as the stock price held, the entire structure survived. If it fell, everything would collapse at once. Arthur Andersen was one of the most respected accounting firms in the world. It was also Enron's auditor and one of its largest consultants. Andersen collected $25 million a year in audit fees from Enron and another $27 million in consulting fees. The firm that was supposed to verify Enron's books had a $52 million reason not to ask hard questions. Andersen's internal team flagged Enron as a high-risk client multiple times. Partners within the firm raised concerns about the special-purpose entities and the aggressive use of mark-to-market accounting. Those concerns were overridden. The revenue was too important. The relationship was too valuable. But Andersen wasn't just negligent, it was complicit. When the SEC began investigating Enron in October 2001, Andersen employees shredded thousands of documents related to the audit. An internal email instructed staff to destroy files in accordance with the firm's document retention policy, a policy conveniently invoked as regulators were closing in. The board of directors played a similar role. Enron's board approved every major Fastow partnership. They waived the company's own conflict of interest policies to allow the CFO to personally profit from entities that were doing business with Enron. The oversight that should have caught the fraud instead gave it permission. Enron's culture reinforced the fraud from the inside. Skilling implemented a performance review system called Rank and Yank. Every 6 months, employees were graded on a curve. The bottom 15% were fired. The result was an environment where everyone inflated their numbers, because showing weakness meant losing your job. Traders were celebrated for generating revenue, regardless of whether that revenue was real. Risk was rewarded. Caution was punished. Analysts who questioned Enron's numbers publicly were attacked. When one Merrill Lynch analyst downgraded the stock, Enron pulled its banking business until the firm replaced him with someone more favorable. The culture didn't just tolerate deception, it selected for it. The people who thrived at Enron were the ones willing to push every boundary, ethical, legal, and financial, because the system made honesty a career risk. In August 2001, Jeff Skilling abruptly resigned as CEO after just 6 months in the role. He cited personal reasons. The market was suspicious but not alarmed. Not yet. Then, Sharon Watkins, a vice president in corporate development, wrote a memo to Kenneth warning him that the company could implode in a wave of accounting scandals. She identified the Fastow partnerships as the source of the risk and warned that the accounting structures were unsustainable. Lay forwarded the memo to Enron's lawyers. The lawyers investigated and concluded there was no problem. Watkins was reassigned. The warning was buried. In October 2001, Enron reported a $618 million quarterly loss. The same day, it disclosed a $1.2 billion reduction in shareholder equity tied to the Fastow partnerships. Wall Street finally started asking questions. The answers came fast, and they were devastating. Enron restated its earnings going back to 1997, wiping out nearly $600 million in previously reported profit. The SEC launched a formal investigation. Credit agencies downgraded Enron's debt to junk status. A proposed merger with Dynegy collapsed when the true scale of the hidden debt was revealed. On December 2, 2001, Enron filed for bankruptcy. $63.4 billion in assets? Gone. It was the largest corporate bankruptcy in American history at the time. 20,000 employees were out of work. Many had their retirement savings in Enron stock because the company had actively encouraged it. When the stock went to zero, so did their futures. The executives at the top had already cashed out. Lay and Skilling sold hundreds of millions in stock in the years before the collapse, while publicly telling employees and investors to keep buying. The people who built the fraud escaped with fortunes. The people who trusted them lost everything. In 2006, Kenneth Lay and Jeff Skilling were both found guilty of fraud and conspiracy. Lay was convicted on 10 counts. He died of a heart attack before sentencing, and under federal law, his convictions were vacated. Skilling was sentenced to 24 years in prison, later reduced to 14. He was released in 2019. Andrew Fastow pleaded guilty and cooperated with prosecutors. He was sentenced to 6 years and served every day. Arthur Andersen was convicted of obstruction of justice for the document shredding. The conviction was later overturned by the Supreme Court on technical grounds, but by then it didn't matter. The firm had already surrendered its license. 85,000 employees lost their jobs. One of the most storied names in accounting ceased to exist. Congress responded with the Sarbanes-Oxley Act of 2002, imposing new requirements for corporate governance, financial disclosure, and auditor independence. It was the most significant reform of corporate accountability since the Great Depression. Whether it was enough is still debated. Enron is not a story about a few bad executives gaming the system. It's a story about what happens when every layer of oversight, auditors, analysts, board members, regulators, is either compromised or asleep. The auditor was paid more for consulting than for auditing. The analysts were punished for skepticism. The board waived its own rules. The regulators trusted the market to police itself. And the employees were trapped in a culture where the only way to survive was to never question the numbers. What makes Enron dangerous as a precedent isn't the fraud itself, it's how long it lasted. For nearly a decade, Enron operated in the open. Its financial statements were public. Its partnerships were disclosed, in footnotes that no one read. The information was available. The incentive to act on it was not. $63 billion, built on contracts that hadn't been fulfilled, profits that hadn't been earned, and a stock price that existed only because no one with the power to question it had a reason to.